Good morning, everyone. This presentation explains the goal and core functions of financial management, distinguishes the qualitative and quantitative steps of sensitivity analysis, and then finally describes internal and external financial methods used to measure project risk within capital budgeting decisions. Today, we're starting with fundamental objective of financial management. While many people think it's just about making a profit, the primary goal of financial management is actually to maximize shareholder wealth. This means our decisions should be focused on increasing the long-term market value of the company's stock. This is a key distinction from maximizing profit. A narrow focus on short-term profit can sometimes lead to risky decisions that harm the company down the road. Wealth maximization is a more robust approach because it forces us to consider not how much the money we expect to make, but also when we will make it and how much risk we're taking on. It's about building sustainable long-term value for the owners of the company. Financial management focuses on how an organization plans for, acquires, allocates, and safeguards its financial resources to maximize firm value. Financial planning establishes budgets, forecasts, and cash flow projections that align financial resources with strategic objectives. Financing decisions determine the appropriate mix of debt, equity, and internally generated funds while balancing risk and minimizing the cost of capital. Investment decisions, often referred to as capital budgeting, evaluate projects using techniques such as net present value and internal rate of return to ensure the firm invests only in opportunities that create shareholder value. Working capital management ensures day-to-day liquidity by managing cash, receivables, inventory, and payables so operations can continue without disruption. Finally, financial control and risk management involve performance measurement, internal controls, and risk mitigation practices that protect the organization from financial losses and uncertainty. Now let's shift to risk analysis. A key tool is sensitivity analysis, and it's not just about math. It begins with qualitative judgment-based steps. First, we must identify which variables really matter. We use our experience and business knowledge to pinpoint the key drivers that could make or break a project. Is it sales volume? The price of a key raw material? We also define exactly what we're measuring, such as net present value. Next, we determine a plausible range for these variables. We can't test everything, so we make educated assumptions to create a best case, base case, and worst case scenario. This frames the scope of our analysis. Finally, after all the calculations are done, the most important qualitative step is interpretation. The numbers don't speak for themselves. We have to now analyze them to understand what they mean for the business and use that insight to make a strategic recommendation. Once we've set the stage with our qualitative judgments, we move on to the quantitative steps. This starts with building a financial model, which is the engine of our analysis. This is typically a spreadsheet where all of our variables and assumptions are linked by formulas to calculate our final output, like profit or net present value. The second step is the core calculation. Here we plug in the best case, worst case, and base case values for our variables and run the numbers for each what-if scenario. This is where we see exactly how sensitive our project is to changes. Finally, to make the results easy to understand, we visualize them. A tornado diagram is a great tool that ranks variables by their impact on the outcome, immediately showing us which risks are the most significant. This visual approach helps translate complex data into a clear story. When we integrate risk into capital budgeting, we can use several methods. The first category is internal methods, which focus on risks inherent to the project itself. We've discussed sensitivity and scenario analysis, which test the impact of changes in internal forecasts like sales volume or operating costs. A more powerful method is Monte Carlo simulation. Here we assign a probability distribution to each uncertain variable and use a computer to simulate thousands of possible outcomes. This gives us a much richer view of risk, including the probability that the project will have a positive net present value. A different approach is the certainty equivalent method. Instead of adjusting the discount rate, we adjust the cash flows themselves. We ask, what is the guaranteed cash amount I would accept today instead of the risky future amount? This directly incorporates our risk tolerance into the cash flow forecast. In addition to internal methods, we also use external methods, which assess risk by looking at market data. The most common external method is the risk-adjusted discount rate. The logic here is simple. A riskier project must promise a higher return, so we add a risk premium to our standard discount rate. This sets a higher bar for the project to clear. But how do we determine that risk premium? That's where the capital asset pricing model, or CAPM, comes in. Developed by William Sharpe in 1964, CAPM provides a framework for calculating the appropriate discount rate based on the project's beta, which is a measure of its risk relative to the overall stock market. By finding a comparable public company, we can use its beta as a proxy for our project's risk, allowing us to ground our decision in objective market data. In conclusion, effective financial management integrates planning, financing, investing, and control to ensure that resources are used efficiently and strategically. By applying capital budgeting tools and risk analysis techniques, managers can make informed decisions that enhance profitability while maintaining liquidity and stability. Ultimately, the goal of financial management is to maximize firm value and support long-term organizational success. Thank you.